You're listening to Smart Moves with your hosts, Ann Riley Caldwell and Matt Wilson.
Hey, welcome to the Smart Moves podcast. Today, we're going to talk about, are you ready, credit scores. And we're going to talk about the credit score shift that might help more buyers actually qualify. So there were some changes that were made on April 22nd, 2026. So we're going to go through those today. And thanks for watching the Smart Moves podcast. I'm Ann Riley Caldwell, not your ordinary agent. And I'm here with my co-host, Matt Wilson, loan officer, New American Funding. Also not your ordinary lender. I don't know if he likes it when I say that, but it's true. Anyway, in the Smart Moves podcast, if you don't know by now, we're here to help you make smart, strategic moves, make your life as easy as possible, and give you advice when it comes to real estate, loan products, and mortgages. And also sometimes we throw in life advice. So we'll see if that happens today. So anyway, there is a little bit of a credit score shift thanks to the hold on, let me get all my technical terms right. I'm going to throw it out here. FHFA and also HUD. So they have come along, and for FHA, Fannie Mae, and Freddie Mac, we have a few credit score changes. That big three numbers that everybody asks you, hey, what three numbers are you for your credit score? They still matter, but there's some things that maybe will be looked at a little bit differently, that maybe those three numbers aren't quite as important as they used to be. So Matt's going to fill us in on that coming up here. So let's start with, there's a new scoring model. Okay, everybody get excited here. The VantageScore 4.0 and the FICO 10T. I'm sure all of you know what that is off the top of your head, but we're going to have Matt tell us for those of us that just don't know.
To be honest with you, I don't even know what that means behind the scenes. So, and I do this for a living every day. I'm sure that it matters greatly to the great people at FICO. But that being said, here's what it actually means for you. Basically, the first piece of things is, historically credit's looked at a snapshot of time right now. Yes, there's historic data and things like that are going to go into the algorithm. But now, if over the last 24 months you've made it a habit of paying down revolving debt or other debts and not just minimum paying credit cards and stuff, that's going to favor more highly for you. And the other factor there is it's also giving a little bit more weight to rent and utility payments. Now, I'm going to hold judgment on that until I see how it actually impacts things in real life. Because I will say in the past, there's been the stuff that you could go put your utility payments on your credit report for yourself. And to be honest with you, in most cases, I didn't see that it made a big difference in those situations. But maybe with this new algorithm here, it's gonna change things for the better. They claim that it will. So time will tell. If nothing else, I could see that helping you get, this is not confirmed, this is conjecture just for the record, but I could see that helping you if you're in like a thin credit situation where you've only had credit for a few years or you've only got like a single credit card or something like that. I could see that helping get an automated approval on a mortgage be a little bit easier just because it's got more trending data to look at than just the one credit card for $500 that you got at Victoria's Secret 6 years ago and pay off every time you'd look at it. Let's face it, if that's the only credit somebody's using, that doesn't really give a good indication of how likely they are to pay a mortgage on time. But if you've been paying rent forever and it's always been on time, then you're probably good on the mortgage.
Yeah, so that's referred to in this context as alternative data, because we do have some people that, we still run across a few people that have no credit score. I would say that's more rare, but as Matt said, it's more people that don't necessarily have a lot of, I think we call them trade lines. Is that correct, Matt?
Yeah. Each individual like credit card or car loan or whatever, in professional terms, that's referred to as a trade line.
Yeah. So anyway, so in those situations, being able to look at some of this alternate data, or if the alternate data is really strong compared to things that happened further in your past, you might be able to do something sooner than you think. And then also the third part of this is the removal of the 620 rule. So we're going to let Matt talk about the old credit score, and a lot of people hear that you need a 620.
Yeah. So historically, if you were going to obtain a conventional loan, you had to have a 620 credit score or above. The way that they have changed things now, there's technically not a minimum credit score, but here's a couple of things to be aware of. First off, even before this change, if you had down to a 500, you could still do an FHA loan or a VA loan potentially. They would require down payments in those situations, and the down payment is going to be significantly more than it would be if you had a good credit score. But and I've personally closed people with 550 credit and stuff. There just has to be a lot of compensating factors, and all that a compensating factor is like, do you have a bunch of money saved up, or a new windfall of money, or significant income that we can't count because maybe the income doesn't count for the mortgage guidelines, but you did actually earn that extra bonus this year, that sort of thing. So, it's not like it's going to change the world as we know it, that the 620 is gone. The other factor to consider there is this. From what I can tell so far, the only time any lender is going to allow you to go below a 620 is if the automated system approves you. We're not going to manually underwrite that. So if for some reason you needed to go conventional and you're below a 620, it has to be relatively clean from a debt to income standpoint. It needs to be a low debt to income, and it's going to probably require that you have some reserves there to fall back on. And all that reserves means is that, after you close on the house, you've got extra money left over to pay mortgage payment for a few months. Ultimately, the goal behind all of this isn't because Matt, the mortgage guy, wants to be a total jerk. It's all because, we want to make sure that whenever you buy the house, you actually have the capacity to pay back the house. And somebody a lot smarter than me somewhere created these guidelines because statistically, people that fit certain criteria tend to pay houses better than others. So, the thing is, you kind of look at a 620 credit score on a conventional loan. I think probably the lowest conventional loan I've ever actually done a mortgage for was probably 650. Because typically I'll flip it over to FHA in those situations because the pricing is significantly better. If you've got a minimal down payment as well, probably not going to be able to do it down to a 620 or below a 620 on conventional, because if mortgage insurance is willing to insure you, it's probably going to cost a very, very large sum of money. There's one spot that I could see this being a big win for people, and that's like for Freddie, for example. You can sometimes get by on self-employed with 1 year of a self-employment history instead of 2. I just did an application for somebody not recently where that was the difference of them qualifying for the loan induct. If their credit score was down where an FHA loan might have made sense, FHA always requires a 2-year average. They wouldn't have qualified anyway. So, it's kind of just do you take the bad pricing and the fact you qualify, or do you wait it out until a day where you qualify a little bit easier and get better pricing?
Well, and anytime you maybe don't have the best pricing, people can typically refinance later, correct? If they meet the criteria for refinancing.
For sure. And the thing to be aware of too, because this is always a fan favorite, is whenever I get the phone call that's like, "Hey Matt, my credit sucks. By the way, why is the rate that you're quoting me not anywhere close to what I see on the internet?" Well, because what you see on the internet is based on a really, really, really good application and paying a couple of discount points to get a lower rate, typically. Not, hey, my credit's in shambles and we're just going to make it work. Like that's not the formula for getting the best pricing possible.
Yeah. So, you're going to get hit with a bunch of letters from lenders and people offering you what seem to be too good to be true offers a lot of times. Those are just going out to you and all your neighbors probably. So just FYI, everything that you see online, if you read the fine print, it's going to have a probably for most people an unrealistic credit score. It's going to have a 20% down payment. I think that's honestly, maybe that answers the question of why so many people still come to us thinking they need a 20% down payment. I think it's because pretty much every letter and mortgage calculator and everything that you see to try to get your payment to look as low as possible to get you to call somebody is because they factor in a 20% down payment. I think I just answered that question after all these years. So then people who actually read the fine print or see that I think that psychologically they think to themselves, oh, I must have to have a 20% down payment. So anyway, we keep doing everything we can to blow up that myth that you need a 20% down payment. But anyway, yeah, I mean, it's very, very hard to compare apples to apples or oranges to oranges or tomatoes to tomatoes. If you're not actually having a lender like Matt actually look at what all these other people want you to think that they're offering, because again, it's not. I mean, there's no way that it can be based specifically on your information if you have not given over pretty much all of your information. So just FYI. And then the last thing, number 4 on here, that some changes have been made to is credit bureaus are scrubbing some medical debt and some, quote, small collections from credit reports. And then Matt can talk about that. And then also, if lenders have any leeway to overlook some of those things or do anything, about them to help you if you have those.
Yeah, so that right there, I would say, is the biggest actual tangible win out of all this. One of my big complaints about medical stuff, like I personally, a couple of weeks ago, got a call from a debt collector well, let me rephrase that. My wife got a call from a debt collector, and then I got to be the cleanup hitter in that conversation. But in essence, it was about a bill that we received allegedly for one of our kids getting some sort of blood work done or something like that. Here's the thing. If you've ever been to the doctor for anything other than the sniffles, like there's probably 45 other places trying to bill you for something. And you and insurance together can't figure out who all is supposed to get paid or what's supposed to get paid. And then in this case, the only explanation I've got is if they did send a bill out, they sent it to a previous address and not the current one because, I at least check my mail once a week. So all that to say, even the lender's gotten that phone call before. And it wasn't even for me. It was for my dadgum son. Like I had nothing to do with it other than being his dad. But it happens all the time. Like people have no idea that emergency room visit turned into a $500 medical collection or something like that. And while, yeah, you should pay your debts, the thing is a lot of the times you don't even know they exist until we do the mortgage credit pull. And you're like, I had no idea I owed so and so that much money. And that's why my credit score sucks. It happens more often than you'd like. And with this new news, it's kind of a piggyback on something that happened a couple of years ago where they had announced that they were planning on, discounting medical debt as part of the equation for credit scoring and stuff. I think this, if it actually goes into effect properly, will help actually make that happen because we don't have to, as of now, for most medical debt, unless it's just like a significant amount of money in some cases, we don't really have to count that as part of your financial picture. But it had been impacting the credit score previously, which does count towards getting worse pricing or qualifying potentially at all. So, that right there, I think is a really big thing for a lot of families. And even people that traditionally have really good credit can sometimes get hit by medical collections they didn't know existed from the broken arm they had 6 months ago.
Yeah. And I've found the more interactions I have, especially with large companies, they love to keep billing you even after you canceled their service 97 times, gone into the store, handed equipment back to them. They love to send you bills after the fact and tell you that you still owe them $100, $500, and you're having to fight it, and good luck finding a person to do it. So anyway, some of these things are definitely trending, hopefully in a better direction, more of a 360-degree view in some instances in order to try to help buyers that should get qualified and not have some somewhat smaller but overly significant issues potentially stand in your way. So we're here. We've done a podcast before that goes into a ton of detail about credit scores and debt to income ratios. So make sure to go back and check that out. And as always, part of our mission here for the Smart Moves podcast is to keep you up to date anytime things like this change. Sometimes it's more substantial than others. Of course, headlines in the news sometimes blow things out of proportion. So we're here to give you the truth about what's really happening so we can help you make the best decisions for you. Again, we're here to answer your real estate questions, mortgage questions. We maybe got into a few life things, who knows, on some of those conversations. But anyway, thanks again for watching the Smart Moves podcast, and come back and watch future episodes as we continue to give you more and more information to help you make smart moves.